okay. Everybody's flipping out about a tsunami. I
Did
think
you
the
get
water
one?
rose a foot. Huh?
Oh, you didn't. It didn't hit.
I don't know. My wife stayed up all night. we gotta go tie down the boat. We gotta go do this. And we gotta...
I mean, I messaged you last night. It's like, go get those boats locked down.
Yeah. Well, you know what? If they sink, there's insurance for that, and we'll get a new one.
That's true. That's a good point. That is why you pay for insurance.
Exactly.
Do we have a link here? Do we have a link?
Tsunami coverage. Yeah, let's get some people paying attention here if we can.
Why can't I?
There it is. There we are.
There we go.
Live in living color. God bless you.
Thank you. And to you too.
I have to say,
Tim's up 8%.
Friday's show with you guys was fun.
It was fun. We can't repeat that though. This is only going to be a letdown from that.
Exactly. Don't get your hopes up too much, everybody. All right, I think we're good. Ben looks like he's back in his office.
I am.
It's good.
He's in the all
Cali.
AC/DC outfit, back in black.
Back in Cali. It's good. They survived without him. All right. Boom.
There, done.
Done. Agree, done. All right.
Just give it a minute. Give it a minute.
Give it
Your
a
boats,
minute.
your
All
boats
right.
are there. Your boats
What's
are.
that?
So your boats are there. That's good.
My
So if I'm
boats.
coming up here to visit you, I'm happy the boats are still working.
I wasn't worried about.
What I
the
didn't like is
speedboats.
all night long I got these phone calls to open my access road to my 50,000 acres in Hawaii. And I was like, you know what? The gate should be open.
That's the most ridiculous. I didn't even. I wasn't
David's
even aware of that.
Airstream was going to turn into a floatable.
And I've been to Maui a lot. When we were kids, we went there a lot. That road should always be open. That road, we'd always stay in Wailea, down in the southwest of the island. And the road from there to Hana is my least favorite road in America. It's just so long. I can't believe Oprah has a shortcut road that she just has for herself. Need to get Oprah less focused on her road and more focused on Weight Watchers.
And Zuck has a massive estate and bunker and everything else out there, so must be the place to go hide. Are you guys ready?
Why go there when you have New Jersey?
Exactly. It's so much nicer in the summer.
That's exactly what Steve was thinking.
Oh, makes me sweat just thinking about it. All right, guys, let's get this show on the road here. Welcome to Wall Street Beats. Good morning. I'm Steve Lamar. Today is July 30th. Big week in the markets this week. Big week in macro this week. We had the QRA this morning, which I'm going to ask Ben about. Anyway, so we got Ben Brey. We got David Maris. I'm Steve Lamar. So let's get this show on the road. Actually, and before I do, I want to say this. Just for myself, I want everybody to know how lucky I think we are to have the caliber of analyst / stock expert that we have on this show. These are two of my favorites. And just to have access to these guys' brains a couple times a week, walking us through the markets, walking us through what they're thinking about, walking us through their favorite stocks, what they're liking to buy, what they're liking to not buy, and what they're liking to short is incredibly invaluable. So I just want to say thank you guys, and I, for one, really appreciate what you do and having access to your brains and what it does for our subs and for the show. And anyway, I just wanted to say that. So let's get this show on the road. David, what do you think about this morning? Or Ben, do you want to start? Who wants to go first?
David, go ahead.
All right. Well, I was going to say thank you. I'm almost humbled by that.
No, I'm serious. You guys, like, the experience we on this show is pretty remarkable, and just for people to have access to you guys for 20-30 minutes a week is pretty cool.
Well, likewise, I appreciate you. So let's talk about a few different things. So first, I want to talk about Teva, name that I previewed earlier in the week, and I said, look, I'm still playing it. It's super frustrating because I've owned it for a while. It's underperformed. It outperformed for a while, like a lot of stocks do, and then you wait too long, and then it drops. And what was great about today is they reiterated everything that they needed to reiterate. They said the full year guidance, the revenue number is intact, the gross margin is intact, the EPS number is still 250 to 265. So $2. So this is Teva, Teva, generic drug maker. $2.50 to $2.65. I think they brought that up 5 cents on the low end. Free cash flow of $1.6 billion to $1.9 billion. But again, I keep thinking that this is a 10 times, 10 multiple stock that should be at $25, $26 on a current year number. That's not too stressful. So I would have thought it would be up a lot more today. It is up, so I'll take that as a win. This is going to remain one of my key holdings for stocks here going into the rest of the year. They did talk about the tariffs are embedded into their guidance. I don't know how they can say that because pharma tariffs haven't really been announced, but I'm sure there's enough leeway to the numbers that to anything that's considered. Now, I think generics are a little bit more protected. So I actually think that this is a good one for this kind of environment where a lot of people don't want to own healthcare.
So you were sweating this a little bit, David, from what I recall last week. So any big surprises here, one way or the other? It just kind of came in as expected, and that's a positive, and too much negativity priced in, so the stock's up.
Yeah, and it's not up a lot, so I think it's great that somebody is interested in buying a company that's delivering on what they're saying they're going to do. It's not right. It's not like it's amazing growth or anything like that, and they've had tough comps. So overall, I think it's great, but it's not like a biotech company where they've invented something new. They're executing on a company that had too much debt, too many facilities, and they were kind of near bankruptcy. So now they're just paying down debt. They say in the next year and a half, they're going to get to 2 times debt to EBITDA, which is very manageable for folks that don't know. That's like a really good debt level. Yep. So they also have a pipeline product that is a reformulation of an existing product. And you might say, well, that doesn't sound that exciting. Will people really pay for that? Well, it's for an antipsychotic, which is long acting. So it's a once a month injection. And so for people who are on antipsychotics, remembering to take their medicine and being compliant is really important. They hope to have that filed they plan to have that filed by the end of the year. Everyone expected it would be filed by the end of the year. On calls like this, what you are afraid of is that they're going to say, oh, it slips by 3 months or 6 months, which are very natural. It does happen, but they didn't say that. They said, no, they're still on track for filing it by the end of the year. So that should be out in 2026. So I like Teva. It's a boring generic drug company that I can it's risky, because of all the debt, but it's kind of boring. It's like a Halion, but without the Tums. So
all right, good. Well, it was a big position. I'm glad it came as expected, and you're still encouraged by it. So, and we're sticking with it long. So, good stuff.
Now, did you mention Hims? Is that what you just said? Is that what you said?
I was about to. I saw the thing up like 7% again this morning. So yeah. So I want on your mind.
Well, I want to talk about Friends because this is what happened. I went on the Hymns House podcast, and it's a
Is
small
that why the
podcast.
stock's
It's not
up?
like so. Actually, I did tweet that the day that I went on it, it was up like 15%, and I tweeted, "Is that all because Maris was on this?" And um, so I went on this very small podcast, and out of the blue, I hear from a friend of mine who's at a hedge fund who I haven't heard from in 4 or 5 years, and he's not like, "Hey, how is your family? I saw you on this thing. Just wanted to catch up." It was, "Hey, how are you? Wanted to catch up. By the way, here's my short thesis on hymns," and it's very articulate, and he runs a ton of money at a big pod shop, and it was a very articulate argument that I didn't ask for, that I was already aware of. Um, and so I'll say, so I reached out to another friend of mine. I said, "How should I take this? You want people to remember you as a friend, and they call you up and say, 'I saw this,'" and he goes, "Well, first of all, he did do that, so don't. He saw it and he thought of you and he reached out. So that's but more importantly, people are getting carried out by some of the volatility in the market at these pod shops, and this is a battleground stock. 35% of the stock is short the last time I looked. That's not, for people who don't know, I don't know if I've seen more than 35% in a stock. It's the most shorted stock, again, according to Him's House, the most shorted stock on the NASDAQ. Whether that's true, whether it's not, I mean, it's
Yeah.
high.
Yeah.
So a day like today, where you see it up 7%, which I'm happy about, I still have a small position, is great. They report next week. The bulls think, "Oh, okay, this is going to be great because the management team knows how to manage things." If you read the Q, they have a lot of warning about what the quarter is going to look like. I still stand by the idea that I don't think individuals should short stocks unless they're ready to lose some money. And I would never short a company that doesn't have a big debt or negative catalyst coming.
So what was there anything about what he said, David, that caught your eye or was news to you or gave you something to think about? I mean, look, these
it's
guys
not,
do a lot of work. I always like hearing the other side of the story.
yeah. And another really good friend of mine who I talked to a lot called me a couple days after it and said, "I didn't want to call you right away because I wanted to." He was a little upset because I know he's short the stock, and he's like, "I know you didn't go on this to hurt me, but I just, and they both had really good arguments of the FDA sent a letter recently, last week, that said, and it may even be this week, given how long the week feels. The FDA, a bunch of congressmen sent a letter to the FDA saying, "We want you to look into the illegal compounding of semaglutide or GLP-1s, uh, including the non-authorized import of unsafe ingredients." If you read the letter like to the T, it looks like they're just targeting importing of bad ingredients or illegal manufacturers, which Hims is not. Now, at least they say they're not. So I don't believe they are, but we'll leave a court for that to decide. But if they ever do that, but the long story short is, both of them said, "Look, this is the start of Congress starting to ask the FDA to look into this whole thing." And so it's pulling on a thread. Once they start asking the questions, then it'll get down to more and more and more. And that's probably true. So my overall view is that, are they exploiting a loophole? Yes. Is that loophole, are they, from based on what I can tell, I'm not a lawyer, but are they exploiting a legal loophole that physicians are allowed to ask drugs to be compounded for personalized medicine? 100% yes, that's what they're doing, I think. So does that loophole need to be closed, or should it be closed? If you're Novo Nordisk, yeah, that's what you think. So then yesterday, by the way, Novo Nordisk had a new CEO announced, and 20 times they mentioned on their call that they're going to go after the compounders, that they're blaming all of their troubles on or a lot of their troubles on compounders. You know what?
Yeah.
You're losing to Lilly. I played Little League. I know what it's like to blame people when you're a child. Grow up, Novo. It's not a compounders issue. If people can't afford the drugs and they're using compounders, if you take that off the market, they're not going to rush and be able to afford Novo. I'm not saying that's a justification for there to be compounding just because people can't afford things. What I'm saying is the argument that that's somehow hurting your sales, I don't believe is the case, at least not materially.
Yep. So David, does that loophole get closed? And if it is, how long does something like that take? These guys have pretty powerful lobbyists out there. It wouldn't surprise me if they were able to do it. And then is this something you wake up one morning and the stock's cut in half if that happens?
I think like 30-40% if they weren't allowed to do any more compounding. Now, the problem is that compounding is super important to chemotherapy, super important to fertility drugs, super important to dermatology. It would be pretty.
So that precedent is not one you take. You set here.
I think it's just a very tough needle to thread. Like, how do you say that it's okay for some things and not for others? I get that this is definitely what they're doing with GLP-1s. If you duplicate that with a lot of different drugs, is that okay? No. But also politically, is this the thing that I agree the lobby's super strong, but you know what is also strong? A bunch of consumers who are getting drugs cheaper than they would otherwise that call up and say, hey, what are you doing to me?
Yep. Okay. So that's effectively that's the central theme of the short thesis.
No, there's a lot to it. There are 20 different things that he sent me on the email. But the key is, listen, this loophole is going to collapse. So he asked me, what are you most concerned about? I said, I'm concerned about the law of large numbers. It's just hard to grow the way they are when they added in a hot topic. And then even if they add in TRT and HRT, it's hard to duplicate that near term. So what happens is you then have tough comps, and then the stock might be sideways if they can deliver a lot of earnings, or down if the earnings don't materialize. And then they have to catch up with other offerings. So that's my biggest worry. So that's why I think the second quarter is the most important quarter that they'll ever report, or at least up to this point, because the shortage was resolved. So they even say in their Q, a lot of subscribers should come off because of that, or that's a risk. So how did they manage that guidance? So
yep.
I'm still there. Okay. I think that they're building a platform, but it could be down 20% tomorrow.
Ridiculously impressive what they've done in the last 24 months. Really is.
Yeah.
This thing, I remember you talking about this thing at what, 12, 14 bucks? That's when
15,
that's when I first bought
15
it.
Yeah, 15 is when I came on the show to talk about it. And, someone asked, like, what attracted me to it? The growth. I mean, it's just incredible growth. So sure. A lot happening in the healthcare later this week. We have Bristol Myers, we have AbbVie. And after the close today, we have Bausch Health BHC. So we'll see what that.
Your favorite. Is. All right. Yep. See what that shit show looks like. All right, let's get Mr. Pastrami on Brey here going. What's up with that QRA this morning? It looked like a nothing burger. Everybody was worried Besson was going to cut coupons. He didn't, or at least doesn't look like he did. There's maybe some stealth QE in the back end, but I don't know. What are you thinking? What do you think, Ben?
Morning, guys. Yeah, I kind of told you yesterday that it was one of those things where a lot of people were talking about it, and this administration likes to use forward guidance with a Louisville slugger over your head. You know what I mean? Right. These guys are not afraid to beat you over your head with the way that they're
lip
thinking.
Service. Yep.
But there was no reason to be doing anything out of the normal and screw up the supply and demand situation. The market's at the all-time high. The liquidity is clearly fine right now. And so I don't think making a move like they did in the November of 23 seemed to be worthwhile. They did announce $100 billion of increased buybacks in the long end. And just to remind people that that's basically when you have off the run securities, they trade at a discount to the on the run securities. So give some liquidity to people. But again, as I've talked about, there's a lack of liquidity coming up because of the 30-year not being issued. So there's going to be a supply gap anyway. So I don't really know. I mean, I guess they're clearly telling you that they are not interested in the 10-year going up all that much if they can help it.
Yep.
And one way to see that play out in the market this year, the spread between the 10-year and the 30-year has gone up quite a bit, like almost 50 some bips since the beginning of the year, which is a big move for that spread. And, you could say, oh, it's rising term premiums. You could say that it's the anticipation of the supply gap. You can say it's anticipation of the buybacks. You say that the long end is just, who knows? We don't even know what it's going to be like next week, let alone 30 years. So maybe I need to get a little extra premium to be messing around that far out. And that's, remember, that's the highest vol part of the bond curve. It's about a 14-15 vol, and it's about a 23 duration asset. So it moves around, and it's not like you can just be like, oh, I'm going to get my capital back. Well,
right.
You get capital back in 2055.
Not that easy. Exactly.
So anyway, yeah, I think it was a no-brainer, or it was a non-factor. Yields went up a little bit, but they've had a nice couple days.
Dollar liked it. Dollar still likes it.
So I think that's the bigger story, and I have a few charts. One of my favorite positions right now has been long the dollar. And you start getting involved with that a couple weeks ago in July. We had a little fallback, and the last couple days have been just an absolute ripper. And look, Jen, can you bring that chart up, like versus the euro? The euro's really been doing the heavy lifting, and you can kind of see that now it's broken out of that uptrend. So if it doesn't recover quickly, it's going to be one of those things where all these new Trump derangement syndrome, dollars ending guys are going to be a little bit caught off guard. And look, the GDP
euro is
number,
going to be eating the tariffs.
Yeah, I mean, if we go back to last fall at the end of September up until the election, really up till January, up until like right before Trump was nominated, the dollar ripped, right? And on one of our podcasts, Nadine and I did, we interviewed a guy about China, and he was like, the typical way that guys deal with this is you do a little subsidy. The government can subsidize their exporters in a very mercantilist policy, and then you can devalue. Now, the Chinese haven't devalued, but, you look at the yen at 149, and I don't see them anywhere closer to raising rates, although we have a BOJ meeting tonight. We'll see what they say. I bet you it's a whole lot of nothing. And so we're sitting here where, like, the ADP was okay this morning. GDP, although it was mostly just the delta between the huge Q1 net imports to like a lot less. And I don't know if you guys have seen on Twitter, there's a chart going around that shows you the dramatic delta. And although a lot of that was driven by David's names, the pharma guys just really doing some importing in the Q1 to avoid those tariffs. But it wasn't very strong in consumer, and it wasn't very strong in government, and the investment was actually negative contribution. So I don't look at that as that strong. But again, the Fed seems to be wanting to stand pat. They have their narrative about, we'll see if tariffs cause inflation. the economy. I think the subprime is weak. I think there's some slowing going on clearly, but it's not falling off a cliff. We're not seeing negative 100, negative 200,000 jobs type reports. And when that happens, it happens fast. But until then, I guess the Fed stays where they are, and the yield differentials versus the rest of the world, with the exception of like the Mexican peso and some more, tertiary carry currencies, it's too high. And so the dollar is starting to go back to like fair value, which is probably in the 102, 104 range, based on the cuts priced into the SOFR curve right now. Now, again, what's going to happen, we will see. But I think it overshot itself. And Jen, you can bring up this other chart. And this is a little messy, but I'll just talk about it quickly. So that's a lot of lines. I get it. Okay.
Very pretty.
The lines that are faded is the volatility curve. The bottom is the delta of the options, with 5 delta puts on the left all the way to 5 delta calls on the right of the Euro USD. What you can see is in the beginning of the year, when we were at a 112 DXY, very strong dollar, well, puts were very expensive. And now the skew has really suppressed. And that's been, I have a chart that I don't have with me now, but I think I've shown it before on here when I first was talking about the dollar. A lot of what happened with the euro was just a skew suppression. And what I mean by that is a lot of guys were sitting there, and I have lots of friends in Europe who they were sitting long dollar assets unhedged, right? So when you invest, if me and you and David want to invest in Japan, well, the Japanese stock market over the last couple of years has done quite well. But all we really care about is our dollar returns, right? So we actually, basically, if you didn't hedge, well, the currency is getting weaker, right? And so
Right.
you need to think about international investment as a two-part problem, with the local appreciation of the assets being one, but then what's the FX, right? So I think what's happened from Liberation Day, because I think the beginning of the year there was a decent amount of rate cuts that were priced in, and so that did weaken the dollar some, because the rate of change was faster than some of the other countries that are in the major, Japan and Europe are the major two currencies in the DXY. But basically that kind of ran its course to early April, and since then it fell another 6%. And really a lot of that is, and what I mean by the skew changing, is that there's a lot of hedging, right? So there's a lot of guys who went in there and hedged, and the tick data shows this, and you can go on Twitter, there's other guys who've talked about this, but it basically was a lot of hedging that went on that drove the euro. I think, where did we get to, 118.50 or something? But it's down 4 big figures here in a very short period of time. Less than a week, we're down 4 big figures. And for those of you who don't trade currencies, this is the major one. There's 2 major FX crosses in the world: the renminbi and the dollar, and the euro and the dollar. And this is a big move. And so the stock market seems to not care right now, but the longer we stay with this kind of status quo on rates, the dollar keeps creeping up, and that's the equivalent of money supply destruction or deleveraging on global money supply. And so it tends to catch up. And what you really care about is the rate of change. So you need to see this thing slow down, because if it just if we're back at 110 or 111 in short order, it's going to start to have some impacts, basically. And I also would just make a comment outside of the currency world, although it's somewhat related, everything's connected: tariffs, currency. European earnings stink. I don't know. Have you guys been paying attention to what's going? I mean, Mercedes earnings stunk, Porsche stunk. The Gucci did a negative 25% comp yesterday. The parent company's Karen. Hermes was still okay. But, ASML, their only real chip company, was down 11, 12% because of their guide to begin this. European, and you guys know I hate European stocks. I think European stocks are short. I think the euros are short. The euro short's starting to work. But, there's just so much of it was just narrative based. It's like, oh, the Germans are going to do fiscal spending, and the dollar is ending, and all this stuff. I don't know, man. I lived in Europe half the year for over a decade, and it's just until they have major change of heart in how Brussels runs the zone, it's just too regulated. It's very hard to do business. They don't promote innovation nearly like we do here, and they don't have the same shareholder protection as we do. So, I know the U.S. and as I think, well, me and Steve at least would say, the U.S. market is not cheap, right? So it's not like you're looking around, you're like, oh, there's lots of deals around. But at the same time, people aren't selling their dollar assets as of now. So we'll see what happens here. We have the Fed this afternoon.
Yeah, I was going to ask you, what are you thinking about today with the Fed? Is he giving us any more signal on a September cut, or is he going to say maybe not, maybe even a hike?
No,
Dave, you're on
no
mute.
hike.
Yeah, I was going to say maybe he has a new idea after he's been scolded by that walk around with Trump.
Well, that would be one. Be one way to do it. Talk about a hike in September.
God, that actually is an interesting thing. Like, speaking of tail events, that would be really interesting if he came out hawkish today, just to like say, "Oh, you want to berate me in front of everyone," and in front of our the Fed's new building. I mean, what are we talking about? $2 billion? Like, I don't know all the details. I mean, it does seem a little extravagant. $2 billion. I mean, you could build like a sports stadium for that. But at the same time, the way that the government spends money, I mean, what we talking about?
There's no fun happening in that building for $2 billion. Give me a break.
And the government owns
it. And by the way, it doesn't have to be. It's not that specialized. You just need people with computers sitting in front of spreadsheets. This is not. I mean,
are they doing Cirque du Soleil shows in there on the weekends or what?
Get some DJs in there.
Get something. For heaven's sake.
So look, I guess you just think about it as a two-part problem, basically. We have, by the DSOFRs of next year, we still have 5 cuts. That's not moving. So it's kind of the next couple cuts, Z5 and under, that, are kind of shedding cuts. We only have, let's see right here. By January meeting, there's about 2 cuts priced in. So we've taken some out, right, since the March-April period. And, if they're going to just say ho-hum, there'll be 1 or 2 dissenters for sure. The weird thing about now is, because of the political element of this being so public, there's always a political element. So, it's a little disingenuous when they're like, oh, the Fed's never been political. It's like, no, that's not true at all. Like, it's always
Trump is in his grill like 3 times a week.
Yeah, it's just again, it's like that Louisville Slugger beating you over the head, with the forward guidance. The guys, basically, you're gonna want to see who dissents, how many dissents there's gonna be, and then the tone of the press conference kind of, But I just don't see him giving up much here. And we're at still
too much uncertainty. We don't know what's going to happen with these tariffs. We don't know what the flow through is going to look like. Who's paying for it? Who's not? Too early.
Yeah.
By the way, for individual investors who are used to hearing people say, "Well, but you should have exposure, international exposure," I've always, and I'm sure someone's going to ping me and say this is a moronic comment, but actually the two of you will probably say, I think for individual investors, if you're that interested in international stocks and stuff, just own conglomerates, own something with international exposure. They'll hedge it for you. In other words, what Ben was explaining is, you might buy a Japanese stock, it goes up 30%. By the time you convert it back to US dollars, you lost money, you made 3%, you may not have made money. So if you buy And I'm not suggesting
Your
someone buy
dividends
Merck,
get
but if you buy a
taxed.
Merck or a Coca-Cola, guess what? They're figuring that stuff out for you.
Yep.
But, to go back to the point at hand is, the longer we stay pat, right? The more that like the boomers and the guys sitting on big cash piles like it, right? Because you're getting 430 to 440, on your T-bill and chill strategy, which is higher than everything except for the 10-year out, basically. So, I mean, the 7-year auction was really strong yesterday. It came in at 409. So people are going to try and if you've been winning and your liabilities are fixed and you got a bunch of cash and you're generating cash, well, you want this to go on for as long as possible.
100%.
It's the housing market that really needs rates to come down. It's the bottom end. It's the IWM rate sensitives of the world that really needs rates to come down. So it truly, my sister has a radio show in Wisconsin, and she asked me this morning to give me a 1-minute description of the economy. And I kind of relayed what we talked about. You like that? How she said, I don't need a paragraph.
1-minute description from you on
Steve,
anything.
what's the over under on what it actually came in at?
I actually wrote it out, but I used a simple example. I just talked about our own family. My parents have a house, no mortgage, a bunch of savings. My dad's a bond guy. He was complaining to me this week about how he couldn't find anything over 5 going all the way out to 5 years. And I include some corporate, investment grade and up type of paper. So, there's not much yield beyond that base rate because the credit spreads are really thin, right? Like IG credit default swaps are 50-50 and high yields at 318. The cash is at the tights, with the exception of the really crap. And it's actually, the credit market's kind of an interesting microcosm of what we're talking about. The triple C's are still 150, 160 basis points higher than where they were earlier this year at the absolute tights in February, mid-February. But the triple or the double Bs, which is the very high end, the best credits in the high yield stack, are at the all-time tights, right? So that you can just see it within that as well as we have this real subprime problem or bottom end problem that's real, but at the top, it's like it's Happy Gilmore's Happy Land. You know what I mean? Like everything's as good as it could be right now. So I think the sequence of events is what people really care about, right? Because no one wants to say, "Oh, I want to go to cash," and then have rates come down, without the market coming down. And it's also hard to watch your friends get rich. It's also hard to pay taxes because it's a big tax bill that can happen. You should be looking at some hedges right now because vol is pretty cheap when you move beyond like a week. Like the front of the curve is kind of expensive. These 0DTE guys are really making a lot of money. But you can go out and get pretty decent hedge, and that's just like buying some insurance for yourself, and you sit there and you just own your stocks you like, whether it's the SPY or it's HIMS or whatever. And so, we'll see. We have the Fed commentary, then we have the BOJ. I think we have Meta tonight. I think Meta will be important. That guy seems like he is spending money. And all I'd say about
$100 million per AI guy. I mean, that sounds like a lot.
Apparently, one guy was offered $1 billion comp package from Thinking Lab, which he denied. Can you imagine denying $1 billion comp package? Not like a buyout, just like a job.
Right.
Like, hey, work for me for $1 billion for 5 years or something. I mean, he's getting that Ronaldo money now given out to these guys.
Crazy.
But this guy had no problem spending and then changing the name of his company or the ticker of his company, name and ticker, I guess, to Meta. And crypto has as financial assets come back, but it's the metaverse isn't a thing. NFTs aren't a thing. Like on-chain volumes stink. So they Wall Street got its grips on crypto, and the government's pumping it because they want to have another source of demand for T-bills. But it's a far cry from the world that he was envisioning when he was spending 40-50 billion dollars in capex. So we're in the middle of a massive capex boom. Doesn't seem like the returns are there right now. Google put up the extra 10 billion, which looked like a move.
I think Meta's going to look exactly the same. They're going to have the same type of situation.
I would think so.
At a much higher multiple.
Yep, exactly.
Yeah, I mean, that's right? Like Meta's a different beast. I mean, Google is cheap, for what it is. Now, everybody's view is, and I wish I had this chart. I'm making a presentation for this conference I'm going to in a couple weeks as a speaker, and I pulled up the Western Union chart in the 19th century, and it was a total ripper adoption. And then boom, the telephone comes along, and then the stock did nothing. And in these things, that's kind of what I think the market's implying with Google, right? Its big cash cow was the search business, and they're now kind of saying, oh, well, this is a better version of that. If I want to go ask a question, this is a better search engine for everything that's not trying to explore and click links and maybe that's what this LLM stuff
and
is.
They've got all the pieces. They just haven't figured out the user interface, which is going to be challenging for them because they've got so many assets that this could support.
And they never really have, if you think about it. Like if you go back, they tried to do social, Google Circles. That didn't work. I mean, they have a history of not being able to move into other areas. And I think it was just like their algorithm was great back in the day, and it was the opposite of Yahoo. You remember Yahoo, how busy it was? It was just ads and everything. And they're like, hey, we'll keep it simple. And they struck gold, and people it got embedded. And so it just became one of those things where I use Google and I just used to it and whatever. Like Bing never really took any share, right? Or any of these other ones. You just had, it's just not incrementally better. So people just use what they use, I think is what it was. So Now we have a fight. And I would guess that all these models will end up being a race to the bottom in the sense that there's no incremental difference between any of them. And it'll be a bit like the insurance business, right? Like you always think about why are those Aflac commercials and Geico commercials so funny? Well, they have the best marketing guys because you know what? They sell the exact same thing. Everyone's selling the same thing. And so it'll be about gaining consumer share or business share. I mean, I just don't see the performance being what will do it. But for the meantime, in the market, they need to keep the narrative going. So that's, Google put that extra 10 billion up. Well, they only did 5 billion of free cash flow in the quarter, which was extremely low for them. And, you got to question when do we see the final, like, we're not spending more quarter, right? Isn't that kind of what everybody's waiting for? Because then
it's coming.
It's coming. And I guess the question is who's going to be the first to do it? Like, and they're all kind of, it's a weird game theory dynamic because they're all in on it, right? Their multiples are totally reflective of this. And they want this to work as a growth engine. But if they lose the growth narrative, you could see some major multiple compression, right? And so I would guess you're right, though. I wouldn't see that CapEx number coming down. There would be some incremental bump up. And then, Apple as an opposite side who's just decided we're not going to keep buying stock. Like, talk about a company that just wasted a monopoly.
Yeah, Apple's actually. Yeah, I was going to say Apple and AI is such a great example of being so late to a party and then realizing like, okay, maybe I don't have to spend that much. I'll just borrow it from somebody else. It's just like they did with Maps for a little while. Just, I don't know. We can't figure this out. This is really hard.
Well,
I'm interested to see what they come out with this flip phone. That's going to be their newest innovation, their newest product innovation.
I just love the flip. Remember the Motorola StarTAC?
Yeah.
Motorola StarTAC 20 years ago was the hot phone. If you guys remember, that was
the Motorola Razr. That was my favorite.
The Razr was the follow on to the StarTAC. At that time, 20 years ago, those were the hotness. So maybe there's some nostalgia, but back to Apple, I do think there's something to be thought about of like, I'm going to run it on my model, but like the pair trade opportunity in those is interesting because let's just say that this AI thing is a big capital misallocation, or even if it's not for the long term, most of the time throughout history, these technology shifts end up being a CapEx bust, and then they end up being great technology for society, right? So this would be the first case where that didn't happen. So there is going to be a trade at some point of long Apple and short this other stuff because they're not obviously spending on it. I have no idea when it is.
But what about the argument that the actual trade is maybe the opposite? Because a Google can decide, hey, listen, we partnered with OpenAI. We're just going to we're going to spend half as much. Give the other half to OpenAI to subsidize it. We're just going to partner with them. So they have the ability to down throttle their spending, where an Apple doesn't really. It's interesting. I don't know the right answer to that, but it
seems like everyone's racing to have their own thing, and seems like Ben said, it seems like a race to the bottom. So what if you just say, let OpenAI own the space, and we'll just lease from them, and we'll save billions of dollars in the process.
The problem is they just generate so much cash that they don't know what to do with it.
Yeah. Look, here's the one thing I'd say. I just pulled it up on the Bloomberg, right? Like it's easy to get on their case, but their return on equity 157%. Their return on assets, 26%. Return on invested capital, 46%. Right? So, they're not like ruining it. They're just like, hey, we'll just keep buying our stock and everyone will keep owning iPhones. And, when this thing sorts itself out, maybe we'll buy someone as opposed to, basically doing that. And honestly, think about it. If valuations, let's say we do have a bust here at some point in the next 18 months and all these valuations get smoked. Well, they can be there and pick them up. Be like, hey, we'll buy you guys. We'll buy your tech.
Yeah.
So they're clearly not playing for now. I think that's the thing you could say. So in the near term, you can sell calls against it pretty easily, right? Because what are they going to say that's going to drive the stock higher? As long as what's going on is going on. But yeah, I don't know. They're tomorrow. Amazon's tomorrow, and then we got the jobs report Friday. So so far
we can get back to our summer next week.
Yeah, it seems that way. I mean, I would say so far the market things have come in okay this week so far. There's Visa was down, but now it's up a little bit. Booking was down, but it was an okay quarter. There was a couple bombs here and there, but nothing crazy so far. The GDP number is a little bit, you got to look under the hood, but most people just look at the headline. They're like, 3%. Saw Trump out there talking about we should lower rates because we had better GDP rate. That's what I'm telling you. The guy works the rest.
Yeah, no, he also said in the same conversation that if Powell were smart, he'd drop it to 1% right away.
Talk about pouring gasoline on a fire. Okay.
This a guy who's gone bankrupt a number of times. He likes lower rates.
Let's give everybody their morning back.
All right.
We're going to wrap it there?
Wrap it there.
Sounds good.
Wrap it there. We're wrapping it. All right. Thanks for joining us, everybody. I'm Steve Lamar. This was Ben Brey, David Maris. We will see you again tomorrow. Follow us on wallstreetbeats.com and passes/wallstreetbeats is where you can find us. And we will see you. We'll see you next time. But we'll be on tomorrow with a new set of experts. Enjoy.